Good morning. This is Carl Bacon. This is the Successful Funding Show. It's April 2nd. We got through April Fool's Day yesterday, and now we're back to work dealing with reality. So today's program, we're going to talk about how to position a business to be bought or sold and deal with the funding issues that are related to achieving that outcome. And there are so many different things that we can get into on this matter. And so looking forward to talking with all of you about this to see what we can do. So welcome to the chat room. If you're in the audience, feel free to sign in, share your name, your company, where you're coming in from. And most importantly, if you have any questions on this, this is an interactive audience participation show. I know sometimes we get carried away talking back and forth with a guest, and it may seem like we're ignoring the audience, but I really do want all of you to take an opportunity to participate in today's show, and particularly with the topic that we have in mind. I am waiting for a speaker. Um, 1 second. So we're waiting for my guest, Pat Linden, to join us this morning. And he will be along shortly. So I'm going to set the table a little bit here for our conversation this morning. There are times when a business owner, entrepreneurs, reach a point where they want to sell their business. And if if they're not quite ready, then it gets a little bit harder for them to do that. And if they don't do it correctly, they're not going to get maximum price. So we're going to look at the transaction first from the seller side, which is what do you have to do to get ready? So Pat, are you with us this morning? We'll keep working at it. That's one of the fun things about a live show is it is what it is. You get used to different issues on getting in or out to get your guest on board. And sometimes it goes smoothly and it's not no hitch. And in other cases, it gets harder. So Pat, are you with us?
I think I am. Can you hear me okay?
I can hear you fine.
I don't know why it's not enabling my camera, so might have to just go invisible today.
Okay, we'll use the what we call the secret witness program.
There you go.
We'll go from there. Um, so yeah, no suggestions on that. Sometimes if you've been doing a Zoom call on another line, you have to shut the camera off and come back in. And sometimes if you're using two different cameras, you have to flip back and forth to get it to the one that is linked into this. But anyway, Pat is my guest this morning. Um, Pat is an attorney with the Linden Law Partners, and he has extensive experience in working with the buying and selling of businesses. And with that, Pat, we're going to talk about buying and selling businesses, and then we'll dive into more detail. But please share with everybody a little bit about yourself, a little bit about what you do in your current job position, and then we'll go from there.
Sure. Thank you for that introduction. Pat Linden, I'm the founder of Linden Law Partners. We've been in business for about 10 years. Prior to that, I worked with large law firms for about 15 years. We've also been involved in kind of early stage investing and run some other businesses of my own. So our specialty really is boutique, middle market, M&A advisory firm, primarily focused on advising sellers in sort of their lifetime events, as well as all types of capital raising and venture capital and complex partnerships and everything in between.
So my show is focused principally on raising funding, and I have worked with a number of businesses that are getting ready to be sold. And then I've also worked with people or businesses that want to acquire a business. And so from that standpoint, as you're working with all these different business transactions, what do you see as being the biggest obstacle? What hangs things up? What interferes, slows things down, or increases the cost of getting a business sale completed?
Yeah, I think the first would be, Carl, it's a great question. The first would be is like 99.9999, maybe a little higher than that percent of all selling business owners are not ready for the process. And that's just a fact of life. And so when that's the case, inevitably they're stepping into a situation they've not been through before. I think that there's a misconception about that it's, once you kind of have a high level price agreed to, it's a basic purchase and sale type event, and that's absolutely not true. So I think what ends up happening oftentimes is you get into the due diligence phase. It's overwhelming. You're trying to run your company and in a process that you're not familiar with. Typically the buyer's going to have been through it dozens or hundreds of times maybe. So you're going to be at a disadvantage there. So I think deal fatigue and lack of understanding of the process and lack of preparation are pretty prevalent. And so in a nutshell, those are common issues that make life more challenging for business sellers, and it ultimately makes the deal more expensive and longer. And it also, there's a good chance it will result in lower dollars to that, net dollars to them in the end.
Yeah, it's very similar when I'm working with a business who wants to raise funding. They usually knock on my door, and I say, when do you need the money? And the answer is almost always yesterday. And then I start going through all the things that need to be done to meet the minimum securities regulation disclosures on raising capital, with financials and ownership and different issues facing the business. And they may have some of this information. They typically do not have all the information. And as you described it, it's one more thing on a person's desk who's already overloaded. And then now they have to add more to that stack. And because they're already busy, adding one more thing means it takes more time than it would otherwise. And so we end up with delay after delay, trying to get the document, make sure they're correct, everything's in the right order. And in my case, it may or may not impact the ultimate value that's put on the sale of the company, but they certainly can't go hunting for money until they're ready to do so. And so it creates that long delay. And if they truly have run out of capital and they waited till the last minute to raise money, then they may find that they're overextended, that they're stretched too thin. They may even find themselves rolling into default with creditors or breaching agreements, which does nothing to help the value of the company. So Pat, when you meet one of these common situations, what can you do to, one, what do they need to do to get ready? And what can you do to accelerate that within reasonable bounds?
Are you talking about before the process?
Yeah,
Well, we like to think about it like staging a house for sale. And so the first thing is that you really should optimize your business. I know that sounds easier said than done. I mean, I'm an entrepreneur, lawyer myself, and God knows I have a ton of day-to-day things to work on. And so bandwidth is an issue, but the reality is that just like you would stage a house, you would throw some paint on it. You would do all the typical things typically. If you wanted to maximize your investment, I guess a house is a little bit different. Maybe you don't want to make the investment and you're not going to maximize the price. But I don't know many business sellers with it being such a lifetime event that don't want to maximize the price. So I think that what we like to educate sellers on is think about it like staging a house. It's probably about the only similarity to selling a house because it's about 1,000 times harder from there. But you'd put some paint on, you'd do some things, and statistics have shown that will garner you more money because if you think about a buyer, they're going to come into a house, they're going to see that the furnace works and all this different stuff. They're not going to have to throw more money into it immediately. Buyers want to buy, for the most part, a turnkey business. I think you need to think about it in those terms. So what does that mean in terms of your preparation? It means making sure that your accounting is in order and that you can withstand a quality of earnings type review of some level. And without getting into all the intricacies of what a quality of earnings it means, it just means something when a professional buyer who looks at numbers and has very sophisticated accountants and what forth to analyze the quality of all of your sales and so forth, that you're going to keep your credibility. Other examples would be customer concentration is always a bad thing. So if you're reliant on a few customers or clients, that's not going to be optimal. So having a diversification of customers is going to help your management team. You want the business to be able to run without you. Most buyers, particularly if it's a private equity buyer, they might not be in the space. They're financial buyers, and so they're going to be reliant on the team that you have in place. And if you're looking to cash out and step aside, then the business has got to be able to run without you. And I know from personal experience, like every entrepreneur out there, we all do a lot in our business. So it's important to kind of have your management succession team in place. So that would contemplate things like analyzing what is going to motivate your team to stay on board for something like a sale. So perhaps that's stock options and so forth to keep them enticed or have employment agreements. So everything you can tell that I'm saying, these are not things that happen overnight. I mean, these are things that if you're effective at it, it's probably going to happen over a year or a couple year period. Certainly not going to happen in the middle of the deal, which is oftentimes what you find, because at that point, the buyer has most of the leverage and you're going to lose value. So those are, again, we could talk on this for much longer, but I think you have to really do a good job of putting yourself in the buyer's shoes. And if you're a buyer, what would you want to see in a company? And that's probably going to take an investment on the seller's part with no assurance that they're going to sell. But you know what? That investment is probably going to make your business better, probably going to make you more money, even if you hold on to it. So that's the way I like to condense it, Carl.
yeah. So let's recognize some people in our audience who are with us today. We have Harvey Tuck. Harvey is part of the mentoring team I'm working with on this LinkedIn Live show. He and Don Cohen and Kelly Steinecke are helping me be all I can be in putting this show together, and I'm learning how to do it best. Harvey is in franchising. He has his own show called The Franchise Show, and he, like myself, and I'm mimicking Harvey in this case, I'm looking for guests on this show who are also working with small businesses, helping them be all they can be, and in particular, helping them with funding. And so Harvey has been a guest on my show in the past, and as a person dealing with franchises, he is regularly involved in what would amount to be the sale of a franchise and all the things that go into that. So there's a lot of similarities in a business acquisition to the sale of a franchise, which we'll get into in a little bit. But Harvey, thanks for being with us this morning. Um, so, uh, Pat, one of the things I've experienced, and it's counter to everything that you've been saying, is that I will see a business who thinks that in order to get ready for sale, that they should quit spending money on staff. They'll even let people go. They'll cut back. They will try to drop more dollars to the bottom line so that their profits look more higher than normal because they think that looks good for the business. But in doing so, that seems to run counter to your statement that buyers are looking for a turnkey business. They're not looking to come in and do an overhaul and disrupt an ongoing income generating business. So it seems like this is a mistaken strategy for businesses that are preparing to sell.
Well, not necessarily. I think it depends on the particular business. If you have a bunch of bloated staff that's ineffective, for example, and you have 3 people and that job could be done by one person, and perhaps you have an emotional attachment and we all want to keep employees and keep jobs, then in that particular instance, by leaning up, if you will, it's going to actually improve the quality of the operation, and that's going to be enticing to a buyer. So I don't think that you can look at each particular situation in a vacuum. That's a great example. But let's just assume for the most part that the staff, you really need all of your staff to make the business hum. Yeah, I think it's got to be more holistic in your perspective than just saying I'm going to cut every cost, because the reality is that most buyers are going to look at your figures over a period of years, and the most important figures in most cases going to be your trailing 12 months EBITDA leading up to the sale. So again, this is going to get back to the quality of earnings discussion, and just by doing some clever financial engineering, that's going to be exposed to some degree. So I think, but to go back to your point, I do think that as part of optimizing your processes, one of the things that should be evaluated far in advance is, again, thinking about it like a buyer is, am I optimized? Do I have the right personnel for this particular aspect that a buyer would want to see? So if you're a few years out, it may be the time you want to make that investment that you've been putting off. Or it may be time to think about consolidating, because a buyer is going to go in and do those types of things after the fact too, to make the operation lean and as efficient as they can. So I think you have to think about it with the whole perspective in mind.
Yeah, so this kind of tags one of the issues that I fight with all the time, which is the valuation of the business. I work so much with startups and high growth companies that I'm always focused on the future. I'm looking 2, 3, 4, 5 years down the road, maybe more, trying to figure out where this business is going to go, how fast it's going to grow. And it's been my experience that past profits is definitely an indicator where the business has been, but that buyers are more interested and put a higher value on growth rates of the business? What's been your experience?
Well, I think they look at both, and that's a great question. In terms of sort of what is the mathematical calculation at the end of the day, I tend to see in probably 90% of the scenarios, it's focused on your trailing 12 months EBITDA. There can be exceptions to that, like maybe a high goodwill business that doesn't make a ton of money, but there's a particular reason why a strategic buyer wants that line of business. And they see real value. Perhaps in the tech space, you can see tech companies that are not all that profitable, but they have sort of very accretive annual recurring revenue increases. But going back kind of to your question, Carl, about future growth and stuff, that's certainly important. I don't want to say that won't come into the equation. And certainly as part of your discussions and hiring a broker, banker, et cetera, you are going to look at the future potential of the business and run those models. A buyer's certainly going to run those models. It's certainly going to factor into the enticement level for them as to buying your business. So that is actually equally important. I don't want to minimize that. I think you have to look at that closely. I'm just simply talking about sort of the back of the envelope valuation at the end of the day tends to be EBITDA, trailing 12 months EBITDA. But again, that's a great point, and that has to be factored in. And you have to also be able to articulate your position in your industry relative to your competition. You have to have a great grasp on the industry dynamics themselves. And those would certainly be part of the picture in your preliminary discussions that would cause a buyer to be interested.
Yeah, I mean, there's so many different things. Part of them are driven by what is it that the buyer wants to do. This is something, again, that parallels raising funding. I look for investors who have the most in common, the greatest synergy with what they're already doing and the potential investment into a particular business. And I would suspect that a business looking to be sold would want to find buyers who have that alignment, which is in markets, style of doing business, culture, all those different things.
100%, because that's accurate. Because I think for the most part, this could change. For example, if you were talking about a public company, for example, or some large acquirer that was already in the space, had their own infrastructure, they may be less concerned about personnel because they're going to utilize their own personnel to take that over. But I think call it 80% of the cases, certainly what I see, especially if there's private equity, you do need to think of your acquirer as your partner for the long haul. There is a liquidity event as part of the sale, but Carl, I write about this a lot. Very rarely in a private company sale does a seller just sort of a check gets stroked and they retire and they go retire at the beach. Most of the time, they're going to take some chips off the table, and the acquirer is going to be their partner. They might be required to roll over perhaps a significant amount of money, which basically means keeping a piece of ownership in the deal, which is anywhere normally between 10 and 20%. There's probably going to be employment relationships with executive management that are going to have some real teeth, meaning there's likely to be some considerable incentives, like if certain metrics are hit or what have you. There could be an earnout, perhaps, which is a form of is contingent purchase price consideration. And so in most private company sales, there's often a relationship between perhaps an earnout or rollover equity and employment. And if you get terminated early, for example, there may be a a pullback of your equity or other things that can affect your overall price. So the point being, it absolutely is a partnership for some period of time, call it 3 to maybe 7 years following the closing. So your evaluation, just as you would with any other partner, in those instances, you have to ask all the same questions: who you're getting into business with. And great point, Carl. Are you aligned? Do they share the same vision? And what are the dynamics of the partnership? Because that's going to matter tremendously. Some of the benefits of that partnership could be, for example, you are in the trenches of the business. Maybe you're still a key salesperson. Maybe you're a great marketer. You understand the dynamics. You could be a great CEO. The private equity, or what I tend to speak a lot in private equity terms because we do so much of it, but that it applies across the board. The buyer might have considerable resources to sort of roll you into their platform and help you with their capital and their management and maybe their operational expertise, and what they can bring to the table, for example, can be next level. So it can really catapult your growth in those particular cases if you have a great partner. And it can also be a real give you a real opportunity to get what we refer to as a second bite at the apple, which is, for example, you keep 10% of your money in the deal. I've seen that 10% sometimes be 4 or 5x, 4 or 5x, 4 or 5 years down the road, which sometimes is more considerable than what a founder takes off the table. So that partnership dynamic, I think in most cases, Carl, if you're not just cashing out and they're completely taking over, is critical, no question.
Yeah, so we can go so many different directions, but I know sometimes that a business finds itself where it needs to sell immediately. A health issue arises with one of the principals or the entrepreneur, solo entrepreneur, and they got to do a quick sale in order to deal with their inability to continue operating the business. They may need money for healthcare. They may want to set aside or sink money to take care of their family because of the severity of the illness. But setting aside those situations, how far in advance should a small business start thinking about and preparing for being acquired if it wants to optimize the price point and the transaction?
Great question. So here's what I would say: most sellers won't want to hear this, and they won't believe it, but they will believe it once they get into a deal. So the fastest deal, if you're talking about a deal that's, say, $10 million plus, from beginning to end, and assuming there's been no real preparation on the staging the house events that I've been talking about, but they just decide, I'm going to sell, I'm going to perhaps go talk to a broker or banker. Their broker or banker is going to put together their marketing deck, go to market, solicit interest, get indications of interest, pick somebody, get a letter of intent, negotiate a purchase agreement, or do due diligence, negotiate a purchase agreement, and close the deal, right? $10 million plus deal at a minimum, that's a 9-month process. Just the process of hiring the right broker, interviewing people, getting your ducks in a row. I mean, they have to do their work. They have to do these scenarios that you're talking about, Carl, getting you educated on the market. You're in the middle of running your business, all that kind of stuff. So that's not taking into account the whole optimization element. And you should not assume, by the way, that your broker or banker is going to come in and magically do these things to them. That's not what they do. They do have a very valuable role. They will do some of that type of stuff. They'll run some numbers for you that you wouldn't otherwise be able to run. They have the right Rolodex if you've hired the right person, and they have a lot of experience and they can really add a ton of value. But it is not their business model to come in and do all the optimizations and so forth. I mean, it's not their business. So if you're talking about a 9-month process and you don't have the staging of the house elements that I talked to, how long does that take? Well, it takes a long time. I mean, think about how long it takes to put into place new marketing initiatives or hire new salespeople or to lean up or to put in new accounting infrastructure. It doesn't happen overnight. So from my vantage point, again, this is looking at it. It's easier said than done. I'm acknowledging that. Easier said than done to be on the outside and go, you should do all of these things, because I understand how hard running a business is. But if you're really, really serious about it, you really want top dollar, if you really want to do it like a pro, and you really want to implement the things that I've been talking about, that's a 2-year process. In my view, that's a 2-year process, maybe longer, 2 years.
Yeah, no, that sounds very reasonable to me, because you're trying to put on your best face. You're trying to have enough substance behind it. As you mentioned earlier, you want to have that 1-year trailing financials that makes you look as good as you can look. And so technically you need to be in an optimal scenario over 12 months before you put your financials on the table, so that what they're seeing for that 12-month time period is as good as it can be. I, I
And
mean, I know a lot of
Rich,
this.
I want to hit on another key point that I
Yeah.
think a lot of sellers don't adequately prepare for, that has to be taken into account, is you have to figure out what is the net amount of money that you're going to take out of the deal, and run sort of sensitivity analysis around best and worst case scenario, like you would in any other financial scenario. So that means tax and and by the way, it's not always every dollar is as you know, Carl, it's not that every dollar is treated with capital gains. Most of it is, but depending on the type of business, that's not always the case. And there are negotiations around allocating the purchase price, for example. There can be certain benefits to the buyer by allocating it in a certain way relative to the seller that gives the buyer more rapid write-offs and so forth. So the point being is that's another element that has to be considered in the numbers model, because what you might find is by the time you pay taxes and everything else, maybe it doesn't give you the outcome that you need to make it worth it. Your expenses are always going to be higher than people want to believe. It's not like if you're selling a company, it's not like a $10,000. I'm going to hire an attorney and it's going to be $10,000. You can, and you will lose far more than $10,000 in doing so. But so advisor fees, for example, and being realistic on what it's going to take to have true experts help you through. And then, by the way, there might be other estate planning elements that you want to consider. There can be charity, there can be other legacy gifts and so forth, family planning. So that's another dynamic that the more I do this, I believe is that much more important to think about, because I think it's very easy for us to just think hypothetically, okay, what if I get 10 million out of this and I've got this in debt and I pay that off and I pay X amount in expenses, and then I'm going to model capital gains at 20% and here's my net number. And that's probably not that. That's probably going to, that number's probably going to be different.
Yeah, no, one of the challenges I've seen is quite often the business will point to the top line. They're saying, look at the revenue we make. And then when you start looking at the financials and what drops to the bottom line in terms of profits, I commonly find that the leadership of the business is not paying themselves market rate for the time that they're putting into running the business. And the buyer looks at that and says, well, if I have to replace you with somebody I pay market rates, there's no profits left over. This is truly a lifestyle business, without being derogatory about it, but it's not making a profit. And if in some cases the owners were willing to take lesser income than what it would cost to replace them, and it ends up that the whole deal doesn't make any sense.
That's a great point, and that's another reason why I also think it really behooves you to hire an exceptional broker, an investment banker, and that's a process in and of itself. If you're not adequately advised in that, I don't care who it is, you will overpay for for that particular expertise. Like anything, you have to talk to multiple people, and you have to be advised on what's appropriate and what's not. But putting that element aside, that's the type of advice that a great broker or investment banker is going to be able to provide you, and also position you hopefully in the marketplace in a competitive way. It's always beneficial if you have multiple suitors, no different than selling a house, because it drives the price up. So that's another great point, Carl.
So you mentioned earlier that typically you're going to see this crossover between operation of the business by its current leadership and the new owners. And as part of that, part of the purchase price is going to be paid out over time after the deal is sealed. And this in my parlance is called seller financing, where essentially to some degree they're enabling the buyer to come in and acquire the business. And so they're not getting all the cash up front the day that they sign the deal. So what's been your experience in terms of how much of the purchase price is paid at the day they sign the contract, and how much is paid over time afterwards?
It's a great question, and it all kind of depends on the size of the deal. So if you're talking about a deal that's sub 10 million, first off, I would not expect much or any true seller financing per se to be occurring on kind of a $10 million plus type deal. Those deals become more competitive or more attractive to a wider range of buyers, and so you can drive better terms. And as a rule of thumb, you want to have as little of that as possible, obviously, because there's nothing like cash in the bank. There's no assurance that you're going to get that. What I would say, any deal, to take a step back, any deal, for the most part, even if there's no seller financing, there's going to be a fairly significant holdback of cash in the form of escrow. If you know what you're doing, and the deal is, I'm going to just speak to 10 million plus. If it was below this, it would be different. But let's just speak to a deal that's 10 million plus. If you know what you're doing, you're going to get market terms on that, and there should be no more than 10% of the price that would get earmarked. And you'd want to negotiate, obviously, its release as quick as possible. If you know what you're doing, again, that release point is normally going to be about a year, but you'll certainly see aggressive buyers who try to make it 2 or 3 years or whatever. And that matters because no buyer ever, for the most part, comes in, buys the company, and doesn't find a few cracks in the foundation. So very rarely is the buyer coming in and saying, oh, I got really lucky. I wish I'd paid more for this business. So the longer that they are sitting on your money, and remember, possession is 9/10 of the law, and you're going to give a warranty on every conceivable element of the business, they can obviously claw back. All they need to do is write a letter to an escrow agent, and then you're in a tussle about whether it's your money or their money. So there's always that element, okay? There's also typically probably going to be a rollover equity element of some type. That's not an earn out, and that's not, seller financing or whatever the case is. But getting to the kind of the core of your question, certainly as deals get smaller, there is a seller financing component. I've got a couple sub $10 million deals right now where we're dealing with that. In those particular cases, those are tricky. And the things that you want to think of, and here's the reason why they're tricky. I think a seller comes in with the proclivity that, well, this is sort of like the promissory note on my house. I pay it, or they're going to pay it. They don't pay it, I sue them, and they've got a lot of financial wherewithal. The challenge is going to be in 90% of those cases, the buyer is going to have a layer of senior debt that's going to be your seller financing position is going to be subordinate in all respects to that. So what that means is, here's what it means for all practical purposes. It means that you're not going to be paid unless the senior bank says you're going to be paid. And I probably had 5 or 6 of those scenarios where I've represented sellers with seller finance where that has come to bear because the buyer either didn't hit their debt covenant ratios with the senior lender, or the senior lender didn't like what was happening with the business and they just said, you're just not paying anything. And you can negotiate those things. You can come in and say, hey, senior lender, here's your latitude to where I can pay or where I can be paid, and so on and so forth. But ultimately, like all things, he or she with the gold wins typically. And collateralization becomes really, really important for seller financing. And then you have to get into things like guarantees and so forth, and subordination positions and all that. So it's not optimal to have a seller financing component, but sometimes optimal. I'd like to have a vacation home in Tuscany, right? That would be optimal, but that's not reality. So sometimes we have to deal in what's reality. So the takeaway on that would be, you have to think beyond the numbers in those scenarios, and you really have to get granular, and you have to be well advised on your collateral position and what the true dynamics are to make sure you're going to be in a position to be paid.
Yeah, so let me break that down for the audience. If I'm the seller of a business and the buyer wants me to put 10% or more of the purchase price into escrow, that money is treated as a loan from the seller to the buyer, and the buyer has gone out and borrowed money in order to purchase the business, and it comes in and takes over all the assets of the business as collateral. And to the extent that that first major debt of the buyer is unpaid, the seller is sitting in a second position. They're behind a larger financial institution who can do whatever they need to do to protect and preserve their first position as a lender to the buyer. And you're the seller are not in an enviable position in terms of trying to enforce that, because you're the smaller amount and you're sitting in a second position. So the seller is not only dependent upon the fact that the buyer is going to do everything they need to do to keep that financial institution happy and paid, but if they fall down, then that loan to the buyer is probably lost.
Correct.
So that's why, one of the other complaints I often hear from people trying to sell their business is that the buyer will offer substantially less than the purchase price, and they want to pay them out of future profits of the business, which might have been earned anyway if the business had just continued on its merry way down its path. And so the complaint is that the buyer is not really paying for the business, they're taking the business over, and then they're paying the owner out of the profits that the owner would have earned anyway. Um, these are, and unfortunately, I see this is a common style transaction. This would be in your sub 10 million, below $10 million type of a sale, where a small business doesn't really understand what it's doing when it's being acquired, and setting up a deal where the buyer essentially is running the business with the assets of the seller, leaves the seller in a position of high risk. So they're essentially, they are greatly financing the sale of the business, and that's not a good thing.
I mean, I've seen that come up a number of times, normally with people who don't know what they're doing and they want a company for free. I'd like to, let's start a fund with that concept where I buy a company and I don't have to use any of my own money, and I just use that. It just doesn't make any sense. I've seen that. I used to kind of bang my head a little bit against the wall with people who were talking about that structure. I don't anymore because I don't have the time or patience for the brain damage. I think what that typically means, those are just not legitimate and not credible. It intuitively doesn't make sense. I'm not saying there can't be. So there can be situations where there really isn't a buyer other than perhaps one or two key employees or maybe a family member, and they don't have the cash. And so you can do some non-traditional things like that, where effectively they quote unquote pay for it out of the profits, and then you have to have all kinds of clawback and so forth. But I would say when those come up, I typically tell people, sellers, to run, because it just intuitively, it doesn't make sense. Think about, like, would you give your house away and not get cash at the closing, and then you get paid as the seller if they put together some great, Airbnb strategy? Yeah, I've always gotten brain damage with that concept, but it does come up for sure in smaller deals, and you hear it. It's not uncommon at all to hear that.
So have you ever seen a seller, a small business, intentionally raise money to optimize their position, to position themselves for sale, where they're essentially going to get a payback on their the investment at the time of sale?
Like in terms of like raise third-party money for that purpose?
Yeah.
I don't know that I have seen that. It doesn't mean that it hasn't happened in some way that I didn't see, but I haven't seen that. I've certainly seen sellers invest their own money into those situations, and I've seen like VC-backed companies that I have seen situations where VC-backed companies, kind of sophisticated investors who look at things in this way, will they'll price the money just like they would any other round of financing and so forth. I'd never really thought about it in those terms, but in most scenarios which don't include that, I don't think that I've seen that. That's an interesting dynamic. I could see that being a viable strategy.
And I mean, it seems to me that you have a business that's rolling along, it's doing okay, it wants to be sold because the owners are approaching retirement or something else has come up. But all the things that you need to do to get ready to sell the business, all the things you could possibly do to optimize the business, to me, that starts looking like an investment package where if I raise $100,000 or a couple $100,000 to go out and boost my sales, maybe introduce a new product into the market, get that audit done on my books so I know that all my financials are tight and ready for show and tell. And then understanding that this is a short-term investment. As you described it, you might be a couple years ahead of the sales date. And even if I went to third-party investors to get the money, were looking at an exit for their investment that could have a dramatic impact on the price point that the business gets. So it could even be a high rate of return style of investment to go in and basically stage that business and do it in a way where you bring in those outside experts. You do those things that will clearly be directed to enhancing value and not just for show. And then have essentially an investment vehicle that could accommodate that. I'm just curious about that because I've seen so many businesses, as I say, that when they get ready to sell, they don't have that extra money needed to optimize. They haven't staged or set the table correctly to get that max value, but they could have benefited if there were additional capital thrown onto it for the intent of preparing for the exit for the sale.
Yeah, I could see that being as a viable strategy. I think one of the practical challenges with that is an investor would want it's a fairly high risk investment because there's no assurance that you're ever going to get to the finish line. So it would have to be an investor that had a good understanding of the market. They would have to have a good understanding of what the potential multiple would be, because that's where the return, the justifiable return on that investment would be the multiple. That would require somebody who really understood the dynamics of the that particular industry. But yeah, I mean, look, mathematically, and if you did understand those things, I think it's certainly doable. Could be a good investment. Could work for all parties. I think one of the other challenges to be considered with that is a equity investment of that dynamic. If it's a investor that's going to is really going to analyze it in the way that I described, it means they're going to have some chops and have been through things. And oftentimes equity investments, this, Carl, can be a lot harder than a sale in terms of the process and all that. So there is sort of a process element to consider there, and you're taking on a partner even in short term. So that would be a practical consideration. But yeah, I think certainly that's an option, and in the right scenario, the numbers could work for both parties.
I don't know that equity would work there either, although it might. This would be more likely to be in the form of a bridge loan,
Yeah.
Assuming that the business could handle the additional debt load, and the origination of the loan or asking for the loan would all be based upon improving the value growth revenue of the business. So it would
Right.
seem that there would be some alignment between what a banker or lender might be looking for, but at the same time, it's going to create that higher dollar valuation at the point that the business is put up for sale. I have one other question I was going to ask you about, and this again is in preparation for sale. I talked with a guy last week who had sold his business, and he didn't tell anybody in his business he was going to sell the business until the day after the deal was inked. And to me, that would be kind of like a traumatic shock to the workforce of everybody working with that individual. And it would seem to be contrary to what we're talking about, which is staging the business for sale would seem to require getting the entire workforce on board and behind the sale, and also preparing for this transition, this partnership going forward with the buyer. What's your thoughts on that?
Yeah, I think for the most part, I think it's a pretty transparent process. I would agree with you, because if you are, for example, going to tie people, or you want to tie up, has a bad connotation, but that's not really what I'm saying. In preparation, in getting your management team on board, you might be looking at like equity incentive or other incentive compensation, retention bonuses, and I think transparency with all involved about where you're going and what the mission is. So that's what I tend to find I have seen situations, oddly enough, where it's similar to what you describe, where it's highly confidential and they don't tell many employees, and then they just kind of learn of it. Those tend to be um, either one of two things, like a buyer that's kind of got their own infrastructure in place and they're really going to make a lot of changes right after the fact, and so they don't really care as much about the human element. Or alternatively, it's a really considerable buyer, maybe a public company. It's really a home run for all, and they really want to keep things confidential because perhaps it has to be confidential because you're dealing with public companies, et cetera. And then everybody tends to typically make out in those situations because they end up with better benefits. Maybe they get a raise and so forth. But I think as a rule of thumb, the first approach, which is the transparent end, that's what I would tend to see and what I would expect with most private companies.
So there's, in that same vein or in the same area, we're seeing a lot of movement towards having employees buy out a business, which could be part of a sale or it might be the entirety of the sale. What are you seeing in this area?
Yeah, I've seen a lot of small businesses that are entertaining that. I think those are tricky. Those are tricky because you're looking at a transfer of title, basically, if you think about it, without the money, and with parties that may not be able to come up with the money in those particular cases. There are things like ESOPs and all that. A true ESOP, those are highly sophisticated, not things that we work on. If we do, it's not in the weeds of, that's like a highly United Airlines type. You hear about things like that. That's kind of above my pay grade. But in terms of small businesses where instances where they want to transition ownership to key employees, I do see that a fair bit. The challenging parts of those are, again, collateralization, because everybody goes, well, I just want to take the company back if they don't pay. Well, it's not really as simple as that, because if you actually transfer title, just like transferring a title to a house, the bank has collateral, but you are actually, as the buyer, you are actually the lawful, quote, owner of the house. So to just take it back, there's a process to that. So that can be, that can come up. One way that sometimes we advise around how to structure those is to give a series of purchase options. So it's like, we'll lock in the price for you today. We'll lock in the price at $100 today, and you can pay $20 a year over a 5-year period. But you don't get that additional tranche of ownership if you don't exercise. You know what I mean? That's another way that you can handle those scenarios.
Yeah, so you treat it like an installment sale where
Correct.
title doesn't transfer until you hit a threshold, 80, 90, 100% of the purchase price. Yeah, it's come up a lot, particularly with boomer businesses where there's no succession plan in place. And the government keeps saying, let the employees buy it, but nobody's figured out where the money comes from. And there may even be limitations upon the employee's ability to manage the business. It depends upon what role the lead owners have played over the last few years. If they're still, the champion in day-to-day operations, then that person needs to be replaced. And as you described it, they may stay with the business for a year, 2 or 3 to facilitate the transition. But if they're not available, and again, with health issues, seeing that as a more common problem with boomers, they can't hang in there for that time period. So it raises a bunch of questions, and I think we're going to see some new programs come out of the government. There's been a couple bills proposed by Congress to provide some seed capital or call it base capital that could be leveraged with bank financing to facilitate an acquisition. But it seems like there's several more questions that need to be answered, that it's not a slam dunk. It's not going to happen automatically in that fashion. But all these things are on the seller side. So what I would like to see, Pat, is I'd like to invite you back and come at this from the buyer side and talk about funding on that.
Be happy to.
Because yeah, because it is two parts to the transaction, and the buyer quite commonly is engaged in raising capital to buy in, whether it's an existing business or a franchise, or it's some other type of takeover of the operation of a business. And in that case, there are sources of capital out there, but they all need to be satisfied that what's being purchased has the value and the ability to either pay interest on the loans or achieve a return on investment for equity investors. So that takes on its own issues.
Absolutely. Absolutely.
Yeah. So, Pat, again, thank you for being with me today. I appreciate your being on the show and hitting all the buttons here. Um, uh, we'll try to have you back as a guest and talk about this from the buyer side of buying and selling businesses, and get into depth on that. Thank you to the audience who's been with us here today, who joined us for the conversation. This show is recorded and posted on LinkedIn, and it's being recorded and posted on Facebook. And so you'll be able to find it in other places afterwards if you didn't get a chance to see it today. And that's it for today. So, Pat, thank you very much.
Hey, Carl, thanks a lot for having me. I appreciate it very much.